Happy Friday, everyone, and welcome back to Open Exchange TV. Before we kick into the show, we want to acknowledge Veterans Day. Thank you to all those who serve and have served. Very special day for everyone, and anyone who has family members or anything like that, thank you very much. Let's jump into the show now. Welcome back, Jay Poloski. Happy Friday.
Happy Friday to you, Scott. And yes, happy Veterans Day to all who serve. Thank you.
And listen, you must be happy. Big smiles on your face, big up day in the market yesterday. I haven't seen that in the longest time. But the title of your musings this week, you've gone back a little bit as far as the music side of it is concerned. I don't think I was born when this song came out, but When the Levee Breaks, run me through it a little bit, Jay.
Well, probably not the original song, Scott. Not even I was alive in 1929 when Memphis Minnie first penned When the Levee Breaks. But it was picked up by Led Zeppelin. And, you know, I admit in the musings that I listen to classic rock when I'm at the gym. And so the other day I was bench pressing, and When the Levee Breaks came on, and I was like, you know, it's a pump you up song. So up went the weight. I was doing bench press, up went the weight. And not only that, but I got my title for the musings and the thrust of the article, which, and the lyrics that really hit me were, trying won't help you, praying won't do you no good. When the levee breaks, mama, you gotta move. And so the inflation levy clearly broke the other day, and investors need to move. Now, we've already had the crying and the praying part, right? That was basically the last 6-9 months, most of this year, when inflation kept surprising to the upside, Fed front-loaded its rate hikes, rates backed up higher and higher, the dollar went stronger and stronger, and stocks slid. And it led to investors like us being dazed and confused, to just throw another Zeppelin tune into the mix. But where we ended up, of course, were investors loaded up with cash, right? You had record cash allocations, record low equity allocations. You had the lowest risk appetite of all time. You had put volumes just staggeringly high. Basically, we had rock bottom sentiment and the worst 60-40 portfolio performance in history. And so that sets us up for when the levee breaks, right? All that pressure, all that stuff, both on the inflation side and in the market side, we're at peak levels. The levee breaks, and you get a day like yesterday, which was, you know, the best day for stocks in years, one of the worst days for the dollar since 2009. Rates had an amazing day. Stocks, I mean, we had multiple positions in our model portfolios that were up 10% or more yesterday alone. So it certainly, the song is appropriate, I think.
Well, if you want to get back to sort of my sort of timeline, there was a song by Yaz, The Only Way Is Up. Maybe that could have been a better title for you.
Yeah, except I don't know that song.
All right, so let's stick with this whole levy theme then. What does it mean if the inflation levy breaks? What does it mean for you?
Well, I mean, I think the implications are huge. We just got a taste of it yesterday and a little bit today. I put a list of these together for the musings, but one is clearly that macro volatility stabilizes and declines. So we've had the VIX under 24. We've had, perhaps more importantly, the MOVE index, the volatility index for US Treasuries, is already down 30% from its recent high of around 160. When I looked this morning, it was around 111, 112. When inflation rolls over, and I think inflation is going to just continue to gradually decline, rates stabilize, they decline, and stocks should do well because we've already priced in a terminal rate of 5%. And, you know, we may get there, but I think we may not. But yesterday and the day before highlight that we're highly unlikely to have that terminal rate have to go higher, right? And that was the worry the prior week, that terminal rate was going to have to keep being priced out and pushed out. So when the rates fall, the dollar rolls over, and we've spoken about it at length. We think the dollar holds the key, and the dollar had its worst day against the yen in 24 years yesterday. Had one of its worst days since '09 altogether at DXY. DXY is now broken through multiple supports, is trading around 107. And so that to me sets up the opportunity set for commodities, which should do very well. And you're in a position where inventories are extremely low in the commodity space, not only oil, but also copper. Check out the copper to gold action in the last couple of days, pretty significant. And obviously a big help to non-US equity markets, which have started to break out and are extremely cheap versus the US. So a lot of opportunity there as well. And then finally, I think what it suggests is that the middle way, the path that, we've been talking about since way back in the summer. We wrote about the middle way in August, talking about the middle way between sky-high inflation and recession. And I note that Goldman Sachs is even now talking about a very, very plausible path to U.S. avoiding a recession. And that sets us up for our call for a more stable 2023, which, as you will recall, was the title of our monthly Stability Ahead, which we just wrote a few weeks ago. So I think ultimately this sets us up for a better 2023 and suggests that yesterday's action is the beginning, not the end.
Okay, so as you've touched on there, you've written and spoken a lot about a more stable 2023, and we're all ready for a stable 2023. Like, you think back and like what everything's happened over the last 2 or 3 years, like, wow, I need a breather, you need a breather, everyone needs one. But let's go more into it for us. About what does a stable 2023 look like to you, and why should we be looking forward to it?
Well, first off, you get inflation ebbing. That means central bank can take their foot off the gas, not just in the US, but also in Europe. It means that Asia has a chance to grow, right? We've highlighted the desynchronized nature of the global economy, both policy-wise, i.e. Bank of Japan and People's Bank of China are not tightening, they're easing, if anything. And that's led to a differentiated growth path between the US and Europe slowing and Asia picking up. Japan just reported, as an example, its PMIs the other day, and they were the best they've been in 7 or 8 months. So while PMIs are falling sharply in the US and Europe, they're actually continuing to go up in Japan. Yet nobody pays any attention to Japan other than, yen collapse and systemic risk, which was what everyone was talking about 3 weeks ago. Completely wrong. So you have a more stable macro backdrop. And I think that stable macro backdrop is going to be augmented by potentially 3 important factors. The first is on the battlefield in Ukraine, right? The whole conflict began in 2022. 2023, we could see a ceasefire, we could see a significant downshift in the conflict there. Russia just walked away from the only provincial capital, Kherson, that they occupied through this invasion. They've now abandoned it. So the pressure is clearly building there. Secondly is the European energy crisis. I noted today, again in the Musings, that the front month contract for Dutch natural gas is threatening to break 100. Remember, it peaked in August, September at 360 euros, 360 to under 100. Okay, so the whole worry about energy shortages and rationing and deep recession and earnings collapse in Europe, I think is starting to really fade. And then the third, and again, we're getting evidence of it, the third is China moving off of zero COVID. And again, today, they announced 20 micro measures, and this is the way it's going to be done, Scott. It's not going to be President Xi standing up there saying, oh, zero COVID was wrong, sorry, we're going to do something else. It's going to be, little steps and making changes as they've announced overnight, 20 micro changes. And the bottom line is we're not going to see the massive lockdowns of whole cities as we did in the spring of 2022. And this is really important because in the US, as you said, yeah, we're ready for a break from COVID, but our big COVID problem was back in 2020, right? In 2021. China, the epicenter of COVID for them in terms of lockdowns was the spring of 2022. So as they move off that, the big challenge for China has been domestic demand. And much as the US consumer has $1 trillion or more still left to spend of pandemic savings, China has also built up dramatic amounts of consumer savings over the last year or two. And so that money could be spent as they move off the zero COVID rigid policy and embrace a much more flexible policy. So those three things, so inflation rolling over, macro risk declining, conflict ebbing, natural gas worries in Europe fading, zero COVID being eased, all that sets up for what we think could be a pretty decent 2023, and certainly the run up from 2022 into 2023 could be quite decent. And so we ended the musings on the note, when the levee breaks, mama, you've got to move. And that's, to me and to us at TPW Advisory, is really speaking to the investors at large, right? All those folks, cashed up, worried. I wrote about in the monthly about my buddy who was talking about Armageddon, right? Armageddon 2 weeks ago. There's so much money and so many people are so mispositioned that the good news for us, Scott, at TPW Advisory, and more importantly, our clients who follow our model portfolios, we're already there. We are already there. So come, we welcome you with open arms, but TPW Advisory and our model portfolios are exposed to the themes that we've discussed this morning.
Well, I just want to go back. You mentioned gold there before, and it's had a big week. And I want to tie this into something else that happened this week. Maybe a few people have heard about it, the collapse of FTX. You saw what happened with cryptocurrency prices and so forth. But then obviously yesterday, the moves in the markets sort of gone to the back end of people not really thinking about it again. It was a crazy 48 hours for it. But are you thinking that people were dumping Bitcoin and going into gold? Maybe that's one of the correlations of the move. Talk to us about the crypto side of it and more on the gold side of it.
Well, the gold, let's go gold first. Gold, I think, is reflecting the collapse in interest rates, right? When you can get money on cash, gold, which is a non-interest bearing instrument, obviously becomes problematic. But I think the setup now is as inflation ebbs, but likely to still, as it ebbs from 8 to 7 to 6 to 5 to 4 to 3, right? We continue to feel, as we wrote about extensively in the monthly, that the Fed is going to not crush the economy to get to 2%. 2% is a completely arbitrary number. There's no economic science behind it. There's no 100-year history. It wasn't accepted as the target until about 30 or 40 years ago, I believe, in the 70s, maybe early 80s. So completely arbitrary. We think 3 is going to be where the Fed may not say, again, like President Xi, Fed's not going to say, okay, 3% is our new target, but they may give, verbiage to the idea of 2%, but they're not going to crush the economy. That's great for gold, right? If you have if we run a slightly higher inflation environment, a high nominal growth world, which again, we at TPW Advisory have been talking about for probably a year, high nominal growth rate environment, then you have a really nice environment for gold. And so, we own the miners in a pretty healthy position. It's not been a great position year to date, but it's been a great position this week. And we think the setup is pretty constructive and extremely cheap relative to history, relative to the price of gold, et cetera, et cetera. So switching to crypto, we wrote at some length, again, over the last year or two, the debate between crypto and climate, right? How do you become expert in these different things? Remember, one of our models at TPW Advisory is TPW20, which is 100% thematic. And for a while, we had crypto exposure in that model. We exited that, months and months and months ago, and made the point that for us, climate is the single biggest global macro trend of the decade, and that's where we're going to focus our attention. And so 40% roughly of TPW20 and a good chunk of our global multi-asset model, our GMA model, is exposed to climate, right? Whether it's uranium, whether it's electric vehicles, whether it's solar and wind, we cover the whole landscape. And one of the great things about the ETF space is you can do that, right? You can pick, URNM, you can pick LIT, you can pick KRBN, and get exposure to climate. And so that's the bet that we made. We just said crypto, climate. Okay, we don't really understand crypto, can't find the use case for it. It's really a case of more people getting invested versus climate, single biggest global macro theme of the decade. We're going to focus over here. And, the thing about crypto at this point is that FTX was seen as the savior. And, it takes away not only its own implosion, but it takes away another set of supposedly deep pockets, right? They were out buying, SBF was out buying all sorts of other crypto people struggling. And now he himself is imploded. So I think it really, suggests another real challenge for that whole space. I think the use case challenge is the single biggest, the coins versus the blockchain. I'm maybe not just smart enough to understand the opportunity set. And, I could admit that without a problem. But I do think that the use case is an issue, and the lack of credibility, the lack of regulatory, the lack of a central bank. I mean, it's not too different what happened in the last 48 hours to what was happening at the bottom of the 08-09 crisis, when, Goldman Sachs and Morgan Stanley had to go to the Fed, go to the window and convert themselves into banks so they could access the Fed window, else they would have been bust. That's a fact. And there's no central bank window in crypto. And so the decentralized nature of it, et cetera, has turned around and become the sting in the tail. And I don't really know where crypto goes from here. I think I feel badly for a lot of people who have invested heavily in the space. And it's going to take quite a while for it to come back, in my view, if it comes back at all.
Yeah, we're probably not going to see some of those forecasts of $100,000 or $500,000 per Bitcoin coming up anytime soon. But we've all been wrong before, Jay.
Oh, yes. The only person in our business, Scott, the only people who don't strike out, I always like to say, are the people who don't swing the bat. Absolutely. Been wrong many times, but yet have lived to tell the tale. And that's really the important thing, right? Not getting so far wrong that you have to exit stage right. But no, we're, I think the levee breaking, the inflation levee breaking is a really big deal for markets. And we'll see how it plays out. But I think our call for a more stable 2023 just got a lot of support this week.
All right, Jay, I'm going to let you go. We have a quick show. I think, where are you off to this weekend?
Aren't you a smart guy? Down to Duke, actually. Going to go watch the Blue Devils play Virginia Tech. Hopefully we're going to go 7-3. And I love our coach, Coach Elko. He said Duke became bowl eligible last week. And he said, well, bowl eligible is the baseline. We want to stay greedy in November, win more games, go to a bigger bowl. And so love that attitude. Right now we're feeling a little greedy at TPW Advisory as well.
Well, Jay, have a safe and great trip and have a great weekend, okay? Good luck with Duke.
Thank you. You too, Scott. Bye-bye.
And for everyone else watching, good luck investing.